Hello, Jason Bates here, owner of Electrum Financial, located right here in beautiful Scottsdale, Arizona, where a mortgage is not a flip of the coin. If you like the lowest rates at the lowest cost, then allow me to put my 30 years of experience to work for you. You've got nothing to lose. Here is this week's mortgage market at a glance. It's certainly already been an interesting year for the financial markets, especially for housing and interest rates. But it's what happens next that will be more interesting. Can anyone really say with a straight face that the last 8 months have been predictable when rates have risen at the fastest pace in decades and to the highest levels in more than 14 years? It's true. The pace and the outright levels defied most predictions. But the predictable phenomenon was more of a general truth that I knew we'd contend with in late 2021. Here it is in a nutshell. The Fed shifted gears on bond buying in late 2021, announcing a gradual wind down of new bond buying purchases to be followed by a series of rate hikes. This shift from the Fed was always likely to concede with rising rates and lower stock prices. The only uncertainty was the size, speed, and staying power of the shift as the Fed attempted to strike a balance between combating inflation without crippling the economy. June's reading of the Consumer Price Index, or CPI, was the only major curveball of the year, generally thought to be a byproduct of the Ukraine war's effect on commodity prices. It made for a rapid reassessment of the Fed's rate hike outlook, as seen in the following chart. The blue line is the market's expectation of the Fed funds rate after the September meeting. Note the big leap in June. Now, to be fair, July's inflation report caused another jump, but it fell back quickly to the previous 2.875% range and has been there ever since. Longer-term rate expectations for the December meeting, as well as June's 2023, have all had more ebbs and flows due to the shift in the economic outlook. Weaker economy equal lower long-term rates, all other things being equal. These longer-term expectations share more similarities with longer-term rates like those for mortgages. Rates recovered nicely in July as markets feared recession, but rebounded sharply in August as data suggested a much more resilient economy. This was especially true of the jobs report in early August, as well as the ISM, Purchasing Managers Indices, PMIs, which are like more timely, more highly regarded versions of GDP broken out by manufacturing and non-manufacturing sectors. PMI data has been responsible for several noticeable jumps toward higher rates over the past month. The same was true for this week when the non-manufacturing or simply services versions came out on Tuesday morning. The services PMI was expected to move down to 55.1, but instead moved up to 56.9, effectively keeping it in strong historical territory, whereas the markets thought it was trending back down to the moderate level. Now, this is all just a fancy way of saying that despite GDP numbers being in negative territory and despite aggressive Fed rate hikes, other economic indicators suggest the economy continues to expand. Now, trying to convince the American people that the economy is expanding is another story, and it is exactly what Janet Yellen is currently trying to do. The PMI data helped push U.S. rates higher at a faster pace than overseas rates as U.S. traders returned from the three-day weekend. But European rates took the lead on Thursday after the European Central Bank hiked rates and warned about upside risks to the inflation outlook. Europe could be in big trouble as they try to subdue a much higher inflation rate than what we have here in the United States. While U.S. economic data is certainly responsible for a good amount of upward pressure in rates recently, Europe and European central bank policies have been adding fuel to that fire. This can be seen in the faster rise in the EU bond yields. Incidentally, the initial jump in the blue line, 10-year Treasury, in early August coincided with several strong economic reports in the U.S. ISM, PMIs, and the jobs report. Long story short, rates have topped out twice, and the market knows what it looks like to see high rates in conjunction with a strong economy. The bigger question is to the extent to which inflation is calming down. After all, inflation is the reason the Fed continues to say it's willing to attempt to restrain economic activity via rate hikes. Looking at the year-over-year chart, it looks like we have a long way to go for the Fed to get core inflation back down to its target, which is why some are saying that inflation will be sticky and here to stay for the foreseeable near future. I've always said and had a problem with the 2% inflation as the target. Why can't it be zero? Remember that inflation is the erosion of the dollar. This means that it will take you more dollars to purchase the same amount of goods. So assuming we get to 2% and keep it there, in 10 years, the dollar would have eroded by 20%, and in 20 years, by 40%. This suggests your children will have to make $50 per hour just to get by. Even with the GDP target at 3%, the 2% inflation rate over time, in my opinion, is not sustainable. But year-over-year data is just that. It includes the past 12 months, many of which contribute to a massive amount to a total that will inevitably be much smaller, even if the economy simply maintains the current monthly pace of inflation. In fact, core inflation only needs to move down 0.1% in the next report to put year-over-year numbers on pace to hit the target range. Once the Fed is reasonably sure that that's happening, it can begin to consider a friendlier shift in the monetary policy that has recently put so much upward pressure on rates. Now, all this brings me to why things are about to get interesting. Summer is officially over. School is back in session. Traders are back at their desks. This week brings the next installment of the CPI data. Shortly, we'll get the next Fed policy announcement as well as the updated rate hike projection from the Fed members. This has made all the more interesting due to the fact that the Fed, by its own admission, has no idea how much it will hike rates in 2 weeks, and that it will only be able to decide after it sees economic data. Given that the CPI is by far and away the most relevant piece of economic data between now and then, and that the Fed has a policy of abstaining from public comment starting 11 days before a meeting, the market's reaction to this Tuesday's CPI data could be tremendously interesting indeed. Let's hope for the best. So there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you. Thanks for watching. And if you're looking to purchase or refinance a home in Arizona, I'd like to be your broker of choice. Until next time, take care and stay safe.